It's a big week. Slow start to a big week, though. So we got OPEX at the end of the week, CPI tomorrow, and FOMC the week after. Hong Kong up the most, nearly 1.5. A little bit of a relief bounce, likely more than anything else. They did just finish wrapping up their week-long parliament session, whatever you call it. Hmm. I don't know. I didn't change anything. It shouldn't be low volume. Always good to ask, though. You never know. I might have my mic sitting on my head, but I don't. Anybody else got a volume issue? Orale. Good morning. It's a little low, huh? Hmm. Zoom always likes to do whatever it wants to do. I don't know. I didn't change anything. You'll just have to turn it up, I guess, and hope it doesn't suddenly change and blow your ears out. Japan down the most. The rumors of them removing the yield controls and actually beginning to raise rates seems to be catching more traction. That wasn't the only reason, of course, but we did mention Friday that they were going to have data in the overnight down more than 2.5 and really closer to 2 3/4. So we can see it hasn't radically affected US dollar Japan yet. Really want to keep an eye on this though. US dollar Japan, um, it's easy to think of this as a proxy for the dollar and the 10-year. It's not, right? But it's easy to think of it that way. So if it's going down, we expect the 10-year and the dollar index to also go down. And if it's going up, we expect them to go up. So just generically speaking, that'd be the idea behind it. And the way that works is if we got the dollar going down and the 10-year going down, then we expect uh, not necessarily tailwinds to the market, but we would expect them to be able to move to the upside with less restrictions. They're not an inverse product, though, like a teeter totter where, one side goes down, the other has to go up. It's not that kind of relationship. Still, the two extremes this morning, Japan on one side down the most, Hong Kong on the other side up the most, and everything else basically sitting in the middle waiting on data. For US major economic events, which is what we use Market Watch for, just the big stuff, got nothing scheduled, but you could see tomorrow we're going to have the opportunity for a liquidity gap play on CPI. We are going to get some auctions today, all up in the front end, 6 month, 3 month, 3 year. It's kind of a slow morning, slow day. Come like the calm before the storm. So this is kind of a big deal with the with that rise in the yen over these rising potential rising rates in Japan. This has got so many implications that we can't even fathom all of the ways that this can affect the market. Right now, it's one of the biggest bricks in the wall of worry. I don't know if that helped. Careful, guys. It's going to get loud. I think I've seen the problem. So probably hear me better now. New camera has a built-in microphone, and it's Zoom probably grabbed that camera's microphone. So you should hear me better now. No change? I tell you. Good, good. That's the key piece. So we're still waiting on Spot Gamma's founder's note for the AM session. I shared the PM one already. They had some pretty good write-ups in there about Friday. The signals Friday in the price action alone was reasonably decent, but when we added in the options plays to everything, it was a nice read on Friday. Things went really well. I just seen that Spot Gamma did have their AM done. They're a little slow to things over there. I wish they would do that morning report just a little bit sooner. So I'm going to get the report thrown into get it shared with you guys. Just take a second. All right, obviously I haven't had a chance to read it. It just came out. But I wanted to get it shared with you because the options flows are going to directly impact the markets, and the options flows are going to be impacted by the data we get from the CPI. So there's some data that's already starting to show up, which we can see in the optionality, and they usually do a really good job of laying that out. Key levels that we want to pay attention to. And one thing that I had noticed when I brought in Spot Gamma's levels this morning was that the put wall was all the way up with us here. Remember last week it was far below us. Now the put wall is literally right at our doorstep. And below that, we got the zero gamma volatility trigger overhead. So we've got all four of the major lines right here in this very small space. Breaking down below the zero gamma lines with nothing down there, we could sell into selling significantly. We'd see the market makers sell into selling significantly with everything so close to us. So that's kind of what I shared the Spot Gamma founders notes for, because while I haven't got their take yet, that seems to me the biggest threat, that selling begets selling, and that we could expand significantly to the downside, almost like a mini flash crash, if things get a little out of control tomorrow. Now, between today and tomorrow, they still have time to roll these, adjust them, make changes. So, it's not like it's imminent. And for a flash crash, it's not like we're talking 10 points. It's even a 5% pullback can be violent if we get all of that 5% in a day. And I know if you're new, you haven't seen something like that, but we have lock limits on the futures that trigger at 7%, and we've hit them before. So 5% really isn't that bad. If things do get out of control this week, we'll focus on the 50-cent pieces, 5150, 5100, and then 5050, and that would still hold us above the 10-week. Even with a little bit of red on this weekly chart, the distance apart that all these moving averages have, their angle and slope, and the clean price action above it, all of this is just a picturesque signal of health and bullishness. We could get a pullback all the way back to 5100, and it still wouldn't even be considered bearish at that point. We wouldn't, quote, get out of trend unless we got below 5,000. So there's a long ways to go before this is even considered in any sort of way a downtrend or a pullback of any notable size. Now bring it over to the daily, and we're riding that daily easily, which implies that we're going to be cutting through it at some point, and we're going to come back and test that 20. Usually after so many tests of the 20, we get a chance to test that 50 again. Seems like we're about due, huh? We haven't messed with the 50 this year at all. No reason to think we're going to hit the 50 other than just having a discussion about the fact that we haven't hit it for a while. Yeah, you know, there's got to be a line in the sand between this is what we think is going to happen and then watching for a setup to play what we think is going to happen, right? Can't just play, oh, well, it's positive gammas and that's it. It's not enough, right? Add to the fact that the volume levels are all out of whack as we're getting closer to OPEX. And so some of the tools that we would use don't really work all that good or are reading more data than they should be reading. The ticks did really good on Friday, and so did the weighted AD. The C tick, on the other hand, I thought was a little erratic, but otherwise price offered fantastic moves. It did what it was supposed to do, went to key levels like it was supposed to, and paused at each one of them like it was supposed to. I thought it did a really good job, and we had the confirming data from the options on the other side of it, letting us know that things were right on schedule. It's a pretty good day on Friday. We do have a market maker move this morning. They're hedging, so they're a little cautious, but they're still trading 91. That's not light enough for us to believe that they're sitting out. So there's trading going on this morning, and there's hedging going on. As I mentioned, we're right at the 10-day, and we're very close to the ADR half. Generally, if we get this close to it, we'll gravitate there and we'll get it anyways. Now, we don't have to hit it. It's not guaranteed that we're going to hit it. But that would be my first instinct, is that we're going to go down there and hit that ADR half. If we get through that, we'll focus on the 0 gamma level, then the 3-week moving average. That'll get us really close to the ADR full and the 20-period moving average. There's really no reason to believe it's going to be that weak this morning. Right? This is a morning where we're waiting on data. And that's what we would expect is a hurry up and wait sort of situation. These auctions are worth keeping an eye on for sure, but unless they come in out of whack, these shouldn't be enough to send us lower and cut through ADR levels and things like that. On a hurry up and wait day, generally speaking, we would buy the lows, sell the highs, and expect a little bit of a megaphone pattern to emerge between now and tomorrow. All right, of course, this gap is the contract change. Depending on your broker, you can try to settle this different ways. As you can see, Thinkorswim already is on the June series. We talked about that Friday, that it would automatically roll. I can force it to go back if I need to, but really there's no need at this point. We can see the volume is comparable this morning between the old one, which is going to expire in 4 days, and the new one. So we have the equal point of controls, kind of a sloppy profile here. There's really nothing clean about any of this. The 70% is on the low side and very narrow. It's about 70 points. So there's really not a lot across the top that we have to be concerned with. And with all the levels now either at our location or directly underneath us, cutting through them shouldn't be too difficult. That's the main takeaway. Is it's not going to, I don't think it's going to take very much for us to go to the downside. But we're not talking about, some reemergence of a bear market or anything like that. It's just a little bit of weakness in a hurry up and wait environment. We got a new VPOC this morning. This is from Friday's levels. $51.97.25, just in front of a pivot point. Any sort of move up today is going to have to deal with that level. At the very least, we should get a first touch play out of it. And if you think about how it was formed on Friday, we had that run to the downside and it came into liquidity, and it was the previous day's RTH low. And of course, they tried to defend it there before they lost it. Then we took another run up and had another shot at it towards the end of the day. Just for easy numbers, call it 5,200. We already assume that a round number is going to be difficult to get through. You can add this to the fight, right? All right, so last week we talked about how wide this week's box was, but it wasn't set in stone at the time. Now it is. And without having to be too perfect about it, we can mark last week's range and set it on this week's range And you can really visually see how much more volatility they priced into this week's market than they did last week's market. I'm sure some of this is CPI, but not all of this. It has to be more than that. So OPEX is a pretty big deal. That's part of the reason. And then, of course, CPI is the other half of that really big deal. So the market is concerned, and it's being priced into the markets through the options. Otherwise, this range wouldn't have showed up at all. We're basically at the 10 days, so a little bit of a reset. And as we've talked about before, we've been lower than the 10 this year a number of times, but most of those have been quick dips down below the 10, tagging the 20 and running right back up again. So we really haven't had a sustained move below the 10 since basically the first of the year. We're still 3% above the 10-week. So in the bigger picture, we haven't really pulled back all that much. We need to digest this level and hold here while we give the 10 time to catch up to us, or we go back to the 10 really fast on the weekly and get a reset that way. One way or the other, we kind of need a little bit of a reset. So over the last 5 days, utilities up more than 3.25. Healthcare is basically flat. Technology down more than 1.5, and consumer discretionary down more than 2.5. It's been a capital rotation in the last 5 days that it's really hard to believe that it's done yet, right? We're likely to see more of this. So weakness in the fangs is going to equate to headwinds on the market. It's not that we can't rally without them, because, I mean, as long as they're not falling, we can rally without them. But we can't rally if they are falling. So if they're flat and not dragging us down, then we could get those kind of days where it's those choppy, nasty grind higher. Those to me are the hardest to trade. Give me a good clean range or a really nice breakout trend day. I'll take either one of those over a nasty grind to the upside. The good thing is you should be able to spot it if it's going to be that kind of day. You'll see the fangs basically flat, not going anywhere. You might start seeing more of the financials popping up a little bit, and you'll have other sectors, other industries doing really good. And we still won't get nice, good, clean breakout continuations. The ticks on the tick chart will be crossing back and forth above and below the zero line rather than holding to one side or the other. And the weighted AD will fail to get above 250. A lot of times it won't even get above 200. It'll just stay there and kind of chop about, fade back towards zero and run back up to 2. If it's going to be one of those grindy days, that's the kind of stuff we're going to expect to see. Semiconductors are down after NVIDIA pullback. There's been a lot of talk over the weekend about NVIDIA. And look, I mean, nobody knows it could fall all the way back, but there's no reason to believe that. It was due for some profit taking. At some point, people were going to take profit, and then it just accelerated a little bit, right? But all the numbers show that that this thing can easily hit 1,000 plus some, but there's got to be some digestion, right? It's got to pull back at some point. We don't want markets that are structurally unsound. There's been no new data since their earnings on profitability and the products that they make and their sales, right? And the old adage in the market is strength begets strength. Strong names attract eyes who trade it and invest it. It continues to go higher, which attracts eyes. People trade it and invest it, and strong just keeps getting stronger until something fundamentally changes. News, leadership, something, right? And nothing like that has changed. So there's no reason to believe that NVIDIA is suddenly going to drop back down again, all the way back where it came from. It's just digesting after getting a little ahead of its skis. But in that, we're also likely to see the same space get hit. MU, Taiwan Semiconductors, SMH, MSCI, we're likely to see a lot of other semiconductors getting whacked too. So we have the FANGs down 0.5% with semiconductors behind it. And for what's up? Bitcoin, China ADRs, and solar. That's not the kind of foundations you want for a rally, right? We didn't see it on Thinkorswim, but pot stocks are down too. Wow, TrendSpider came out with yet something else new. We'll get there later. So now pot stocks, semiconductors, nat gas, airlines, almost uranium, a little bit more, and they'll be on the list deep enough. So for the other side, Bitcoin, solar, China ADRs, almost silver, and biotechnology this morning, which biotech's been doing really good too. The Spot Gamma founders note this morning goes into some detail on the semiconductors from Friday. So if you are dealing with semiconductors, it's worth a read. And if you're playing the indexes, understanding how the semiconductors are going to affect the S&P and the NASDAQ, that'd be useful. So it'd be a good read either way. With the China ADRs up this morning, we should have a pretty good play against these JD, Baba, Baidu, Neo, XPEV. So a nice little jump up in JD. That'll put us at the top of this move from last week from earnings where they gapped up really big. Now they're gapping up again to get above their earnings gap. That's really bullish, by the way. What you're going to want to keep an eye on for JD is that it holds above $25. So that's going to be the gap that it created this morning. Really needs to hold that line in the sand. But it's also Friday's level. So what we're basically asking here is that JD doesn't fall back inside of its own Friday's price action. If we do and we fade back a little bit, the key is going to be to keep this breakout. We cut through some unfinished business back here and was able to actually hold it. So it needs to keep it. BABA with a big gap to the upside too. But as you can see, it's a nasty mess, right? There's no pattern here, no rhyme or reason. One good thing about a setup like this is you can put on really wide iron condors one leg at a time, right? Start with put credit spreads on one end, get it for half the width of the spread, and then eventually on the other end, half the width of the spread. If the call spread and the put spread are the same size and you collected the same amount of credit on each one, then you've got yourself a no-lose iron condor. You get something like this on, say, the Russell. We had almost a year where we were running it on the Russell because it just held that range for so long. Hard to see BABA holding it for that long, but it's already been here, for most of the year. Here's the line of the new year. We had already had our high at that point. Got a little too weak on the back end here, but otherwise just holding that range really well. We get the start of a gap close at 76. The other side of that gap is up at 77.68. Some analysts are different on how they call a gap and how they call a gap closed. Some analysts, as soon as we touch this candle in any way, they're going to say we closed the gap. That's not me. We closed up here. So for me, if we closed there and we opened here, and that is the gap that we have, the gap isn't closed until we get back to where we started. We have to get to the close. But once we get in this channel, then we can use the channel itself for our levels and guides. We have to first get through that 76 though, and we're at 74.5 this morning. This gap already did fill. Gapped up perfectly, hit that, and then came back down and closed that gap. You gotta love it. These things are all over the place. Baidu was another one. I mean, look at the beat down this thing has had. Came up off of 98. We're around 100 this morning. So we've gapped completely outside of Friday's range. Round number. We need to keep it, but we can see that we're already starting to get a little weak, fade back. It would be okay if we land on Friday's high, but at this point, we really don't want to see it come back inside of Friday's levels. If we do, focus on that half back mark, 98.88. XPEV is another one with a nice gap up this morning. This has been trying to base and come out of it the other way. Keep your eye on $10. It still seems to be that line in the sand that we can't get through. Lots of unfinished business back here. And as far as we know, those sellers are still in play. We just don't know yet, right? And that was a lot of selling to the downside anyways. So one of the things we want to focus on is getting back to these levels, even that higher end. We have to get there and then get through it and get on the other side of it. Then we can start focusing on some of these gaps to close. Now, these are China ADRs. They move quite a bit in the overnight hours. And so they're more gappy than your normal Apple, Amazon, kind of Facebook stuff. And their gaps are not as present as some of those FANGs and other just your normal general US equities. Gaps are gaps, but if you look at something like emerging markets, China ADRs, things like that, these gaps are so common, so prevalent that the urge to get them closed, so to speak, just isn't there. So I don't play these gaps or gap closes with such aggression as I do with other products. Doesn't mean we don't want to keep our eye on where they're at, though, because generally speaking, they're still going to respect the gap level and respond there. With Bitcoin up this morning, we should be able to play some of their proxies. Riot, Mara, Hut, Hive, MSTR, Coin. All of those should be doing relatively well this morning. And semiconductors are tied directly to crypto. So it's surprising to see that they're down with crypto up. And it wouldn't surprise me if we get a reversal in semis and they run up to match what's going on with Bitcoin, or the other way around, that if semis continue to stay weak and even start falling lower, that we see Bitcoin turn around and start to match it. Right now, this discrepancy between the two can be part of the reason that we haven't sold off deeper in the indexes. So Riot up this morning, not quite outside of yesterday's levels, but it's working on it, which makes it easy for us. If Bitcoin is going to continue that move to the upside, then things like Riot and some of the others we haven't got there yet, they need to get outside of Friday's range. If that becomes the line in the sand and they all start rejecting against Friday's high, then we could catch that flip in Bitcoin. Mara, same thing, up against yesterday's high or Friday's high, however you want to say it. Coin managed to get the breakout already, but Coin usually does get better flows than its peers. So, so far it's looking pretty good. It didn't even get weak enough to come down and tag that halfback level. But after that first high was set, it hasn't managed to get higher than that. So on one hand, it looks pretty good, but it already has set a top and it's having a hard time with it. That was a pretty good sized move on Friday anyways. And now with this gap up as a continuation from the move that we've been looking at since the 5th, I mean, this is looking pretty strong. If it's topping out now, unable to get out of this big wick and keep it, then on the move to the downside, 240 target, easy. Right, we'll go for the gap close down here and then overshoot it. Getting the gap close would be 242.62, and if we start moving that way, we'll have enough velocity. We should be able to get to 240. I like it. If you want some short triggers, the first one to break would be that halfback. So they were really trying on Friday, and the flows kept going against them, but they kept running it up. Now, it doesn't match this volume level from the end of the month, but that's a lot of pushing they did on Friday. And true that, I mean, they got a lot of pushback against them. That 173.5, that's now the level that we have to deal with, right? That we really got to work our way past this. And we're up a little bit this morning from where we closed, but now there's just a lot of work here. And that line that we set on Friday is the trap. It's going to be really difficult to get through. If we can get through that, then we'll focus on a gap close. Call it 175. There's a lot of work to be done for Apple to turn around. But when we bring it out, look at these levels. This is a monthly chart of Apple. And so, yeah, you can see the weakness. And this is a zone unfinished business. But it's a really big zone. It's a monthly chart. And two, we've barely gotten into it, let alone cut across it yet. But that's the low that we're really focused on with Apple, is that 165 or whatever this is to the penny. And then below that, the halfback. Consider that halfback like an overshoot of this unfinished business zone. One thing about unfinished business is a lot of times, say we're going to continue to be bearish, and we come running down into that unfinished business and we get a little bit of a pop up because there's just a lot of liquidity there. Don't mistake that pop up as a bullish run by itself, right? Because you get into a zone like this, of course you're going to pop up because there's liquidity. But if this is an inverse cup and handle, then we'll expect that pop up before the move to the downside. An inverse cup and handle is a nice bearish pattern for continuation lower. If this is going to be a double bottom, then we'll overshoot. We'll get into the halfback, trigger the bear trap, run it back up. So you can see how we just barely got into that zone. And there could be more at lower levels that we still need to deal with. Once we do start working our way back up, say we at least get this gap closed at 175, get above that, hold it, we can start working on the half back level from this direction. But there's no reason for this measurement yet. We don't know if we've turned enough to begin legging up to even need this half back yet. That was just some impressive moves, especially if you think about how the S&P looked Friday. So Apple, with all its weakness, all its troubles, everything that's been going on, to have those kind of moves on Friday when the S&P looked like this, and the NQ looked like that. So I'd say keep your eye on Apple. It looks like it's trying to turn things around, almost as if they got some idea of something on the horizon. And, you always want to think about it's not just earnings. It can be new product launches, change in leadership, some legal decisions, Investors Day conference. I mean, there could be, a million different possibilities, but it certainly was getting some work done on Friday while the rest of the market was selling off. All right, the ES made the ADR half, and the NASDAQ almost made the ADR half. When we get to the ADR this early in the morning, we can go to the other side by the end of the day. It doesn't mean we're going to, and it doesn't owe us a move up. We could just continue to the downside and get to the next ADR level, but it's something to keep in mind. And also look at US dollar Japan waking up, taking the dollar with it. Not quite seeing the yields yet making a move, but I wouldn't be surprised, right? That's what we want to watch for. You get those three moving to the upside, then, that's a lot of headwind to the market. We would expect continued weakness. Try to map out resistance levels in US dollar Japan and the Dixie. If these hit resistance and can't get through a particular level, start to fall away, then that could be the reversal we need in the NASDAQ and the S&P. We're lining up pretty good this morning. Things are responding the way that they're supposed to. It's looking pretty good. So everybody should have a good day. Be careful, be safe.